Welcome to Retire Smart with David Brooks. I'm Chip Maxwell. David, as always, a lot of news to cover, but we have a few preliminaries this week. First and foremost, I know how passionate you are about history. Well, you are about to take a step into history. You're going to ring the opening bell at the New York Stock Exchange. Tell us how this came about.
Yeah, this is pretty cool. Actually, we were an early investor in a income ETF, a very unique income ETF that we've used for clients. But we were the earliest firms to adopt the strategy and so I've become really good friends with the guys that run that firm, and they were invited to do it. So they get to invite just a handful of people up there with you when you ring the bell, and so they invited me to go. So this coming Thursday, I'm going to be ringing the opening bell at the New York Stock Exchange. Pretty cool.
Oh, that's fantastic. We'll have to ask you about that on the other side of it, too, how it was. Now, David, we being Retire Smart, made the Inc. 5000 list again. Would you explain to people what that is and what it means?
Yeah, so Inc. magazine tracks basically, it's like a magazine for entrepreneurs and business owners and et cetera. But they have a list they put out every year, and it's a pretty prestigious list. Again, it's the 5,000 fastest growing private companies in America. And last year we made it. It was a pretty big deal. Well, this year we've just made the list for the second time in a row. And once again, we're in the top 40% of fastest growing companies in the country. So I think our rank this year was 1,974. So that's pretty awesome that 2 years in a row we've come in as one of the fastest growing private companies in America.
I'm going to share with you and listeners just a quick little story of one of the reasons why we are growing the way we are. David, I can't remember if I told you this last week. A couple of clients of ours, Bob and Carrie, came in, and then we started talking about the radio show, and they don't get very good radio reception in the house. So when it's time for Retire Smart, they go out and get in the truck and back down the driveway to the end of the driveway where they get a crystal clear radio reception in the truck to listen to Retire Smart with David Brooks. And Carrie said, well, I have to. I can't take good notes unless I can hear the show clearly. So not only are they listening, she's taking notes.
That's actually awesome to hear. You know, it's funny. I used to have to do that when I first started sponsoring your show on the station that I met you on 6 years ago or so, because the signal quite didn't reach to where I lived. And so I'd have to go outside just to hear the show. So thank you then to Bob and Carrie, is it? Then thank you for making the extra effort to listen. You know, it's really nice and it's humbling when you're out and about and people are like, hey, love the show. And I was in another store this past week and got somebody walked up to me, are you David? And of course I'm always joking about it because I'm usually dressed not to the nines, but exactly the opposite. I've got on gym shorts and a ragged old T-shirt. My wife yells at me for not throwing away, and flip-flops because I'm running errands and doing the honeydews on the weekend. But we're grateful for our listening audience. Thank you so much.
I'm not David Brooks, but I hear it's a great show.
Yeah.
Thank you for listening.
That has been an option before.
Yeah. Well, listen, Carrie, and anyone else who's taking notes out there, be sure you write this down. Sunday, August 27th at 6 p.m., Patriotic Productions is bringing to town Riley Gaines, the female swimmer from Kentucky, who is speaking out for the integrity of women's sports. She has had to swim in competition against biological males, and she doesn't think that's right. Now, Patriotic Productions, if that sounds familiar, those are the same folks, Bill and Yvonne Williams, who sponsored the Memorial Day weekend parade. Retire Smart was the sponsor of that parade. You were there, David. Our good friend Sharon joined me in announcing that parade. Well, these are the same folks, Patriotic Productions. They've had this speaker series going on for years. Tonto Peranto, the famous Navy SEAL.
I got to do an event
Sheriff
with Tonto.
Clark.
It was pretty
Did
cool.
You?
Now, that had to do with us. It was somebody else's event. And
is that right?
Yeah, he taught me and Melissa a few tricks, on how to shoot guns. It was a pretty cool event. Yeah.
Well, Tom Osborne has been the speaker 1 year for this event, but this year it's Riley Gaines. Retire Smart is one of the sponsors of this event. But if you want to get tickets or make a donation, go to patrioticproductions.org, patrioticproductions.org. It'll be at the Embassy Suites Sunday, August 27th at 6 p.m. We'd love to see you there. And then, David, the phones are ringing about David Walker, the Honorable David Walker, former U.S. Comptroller General, the head accountant of the government. We're bringing him to town in September, Thursday, September 14th at 7 p.m. It's at, well, what used to be the Ralston Arena. It's now the Liberty First Credit Union Arena, but the arena in Ralston near 72nd and Q Streets. Could you just give us a quick thumbnail sketch again, David, of what's going on? Why are we bringing David Walker to town?
So he's going to give it a really nice presentation and keynote on, and just so you know, so he was appointed under Bill Clinton back in the 90s, but he, as you said, he's chief accountant basically, and he's been kind of sounding the alarm. He's written several very interesting white papers, a couple of New York Times bestsellers, books, and what have you, and he is basically done this presentation where he's talking about the fiscal responsibility of the U.S., right? We cannot continue to borrow away to fruition. However, it's not all doom and gloom. Like, I've not had a lot of great news to share for a few months, I think, on the show, but he's going to be talking about a path forward for America, and he talks about where do we end up, say, 20 years from now. If we take action, if the country gets its act together, fiscally anyway, there is a path to prosperity forward. And he's going to lay out his plan of action, but also going to lay out some concerns for where we are today. And I think you'll really enjoy this. It's complimentary. The Riley Gaines, you do have to pay for admission to that event. Those are for tickets. With David Walker, we do have to have you register, but we've taken care of this. There's no cost for David's presentation. And, I know we call it the Ralston Arena, but let's give credit where credit is due, the Liberty First Credit Union, because those folks that are paying the tax bill for the Ralston Arena, they got somebody to give them naming rights, which helps your tax bill, and I'm all in favor of that.
Well put. Thursday, September 14th, 7 p.m., the Honorable David Walker. Give us a call, 402-369-7777. As David said, there's no charge, but we need to know you're coming. 402-369-7777. All right, on to the news, David. Last week, it was CPI, Consumer Price Index. This week, it's PPI, Producer Price Index. The headline from CNBC is wholesale prices rose 0.3% in July, higher than expected. What does it mean?
So the cost of goods and services, PPI is the input cost to produce goods and services. It went back up, and that's really easy to see because we're seeing re-acceleration. So CPI came in as expected at 3.2. That's higher than the previous month at 3.0. So in other words, we came down from the peak a year ago in June at 9 all the way down to 3, and then some of the talking heads, we'll be at 2.6 in no time. No, we think you're going to see 3.4 to 3.8 here coming up the next month. And so we're seeing a short-term bounce in inflation, and that's the sticky inflation I've been talking about for a long time. The nonsense that the Fed had the wherewithal to use the word transitory for as long as they did 2 years ago. This inflation is really stacking or wrecking havoc because it's stacking. So here again, we're in the third year of this, Chip, and we talked about in the team meeting, people are paying about 18% more for goods and services today than they were just under 3 years ago. And that is creeping into the wallets of a lot of people, which is why it's of concern. And, of course, the way our government got through the pandemic was to print all this money. We've talked about $4 trillion that was created through those loans, and that has risen our debt exponentially here in the last 3 years to levels that have never been seen before, debt to GDP ratio, et cetera. In fact, we have a chart we can put up on the YouTube channel for those of you showing you that this is going to be a significant problem. And when we do some of the tax presentations we do, Chip, I go through some of the history of the tax code, and people are often surprised. The top tax bracket, folks, it's 37 today, and I always ask people, how high do you think it's gone? Well, it's gone to 94%. And when we did that was way back during World War II in 1944. Wars were very expensive, obviously. You had the war machine funnel, and we had to get a lot of debt. We went to 120% debt to GDP. It was the only time in our country's history we flashed up over 100%. And it took basically all the way until 1963, 2 decades later, and JFK reduced the top tax bracket from 90 down to 70. So it took 2 decades to put the genie back in the bottle, so to speak.
Well, the only time until now, right?
Correct. Well, yeah. So now we're now 4 years, 4 consecutive years. Yeah. So we're 4 consecutive years. We're over 136% debt to GDP ratio today, right? And we have moderately low tax rates, right? So where does that mean the most likely will go? Well, it means they most likely, if you study history, will go up. Now, look, We'll tell you when Congress changes the rules, we'll tell you about it. But we do know tax rates, Chip, in fact, do go up in less than 2.5 years. That is the current law because the Jobs and Tax Act of 2017, otherwise known as the Trump Tax Acts, are set to expire. Corporate tax rates stay where they are, but personal rates, everybody's going to go up 3 or 4% depending on what bracket you're in. And that's going to be a problem for a lot of people that are not planning for it.
That's the key word, planning. As David often says, be proactive. You cannot afford to be on autopilot in this environment. That's why we offer a complimentary report card. There's no charge, there's no obligation. This is a comprehensive review of your entire financial situation. Maybe you're in good shape. Maybe you need to make some changes. Now is the time to find out. And that's the other half of it. We'll give you grades, we'll give you a report card on where you are now, and we will offer recommendations on where you might want to go. The complimentary report card, 402 369 7777. 402 369 7777. Up next, financial advisor Alex Murray is one of the rising stars at Retire Smart. We visit with him next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. The families we serve at Retire Smart have entrusted us with helping them optimize their quality of life in retirement. We are building a team to provide the long-term, top-quality service our families deserve. That means developing young talent. David, please introduce our special guest.
Thank you, Chip. Yeah, so in studio again, we have one of the younger advisors, younger in age, but he's got some wisdom behind him. He's actually one of the more tenured employees here at Retire Smart. We just started him off really, really young, and that is, of course, one of our financial advisors, Alex Murray. Alex, how we doing?
Good. Thanks for having me back on. It's good to be back.
Absolutely. I hear you're going to take a couple of PTO days off, though, and head up to Minnesota here.
Yep. Got to experience the first Matt Rule game, so that should be interesting. Hopefully we can have a winning season because I never got to experience that in college. So.
Well, I know as Chip had sent me a note, you were coming on to talk about 3-3-5 and how that would play out on our defense, so I guess explain to me what you think we got.
Not quite the expert Tony White hopefully is, but hopefully the defense this year will prop up the offense. So
yeah,
we'll see.
That would be nice. You know what I'd like to see when we go up north for games is maybe if we're going to punt the ball, that the coverage goes to the same side of the field as the ball.
Yes.
that would be good, right?
Hopefully everybody's on the same page this year.
So anyway, looking forward to the start of the rule era here, and hopefully they do rule over the Big Ten West. So, but listen, you sent me a neat article this week, and I think it's something interesting to talk about, and it's Robo advisors, right? The rise and to some degree the fall of some what we call Robo advisors. So tell our audience basically what a Robo advisor is.
Yeah, so a Robo advisor kind of started with the target date fund, kind of where they are going to select your investments based on a time horizon. And so these Robo advisors are a little better than the target date funds. Just taking into account a few more variables, but kind of with the rise of AI, they're becoming more and more popular as a cheaper or more affordable, lower cost advisor option out there.
Well, yeah, and so a lot of younger people who are very comfortable with technology and using apps on their phone to do their investing and things like that are migrating to some of these. Now, I will put a word of caution out before you do. There's some valid ones, and there's some ones that maybe a little sketchy, and we're not going to name them by name, but look where the company is based. There are several Chinese robo-advisors that are gaining popularity in the app stores, and you're giving all your financial information outside of our U.S. borders. Make sure the company you're working with, at least in my humble opinion, should be a U.S.-based advisory firm, and then understand how these companies make money. So we had a big rise and fall. Let's say Robinhood became popular a couple of years ago during the pandemic, and you had the Barstool sports guy trading and acting like, oh, this is easy to make money. Stocks only go up or what have you. And obviously there was a few mistakes he made and admitted to, but some of the what we call custodians or apps these people are going on, these robo-advisors, they make money by selling order flow, and you should know that, right? And so kind of explain what that means.
Yeah, so they're just most of their money is not made off of the actual expenses or fees on the account. They're just getting fees and their cut of it basically from generating trades it's a lot of shorter term trading going on with, especially with the younger clientele they have.
Absolutely. And so for younger people that think it's fun to trade these things, I will again throw the caution wind up and is understand if you buy and sell a stock, whether it's 3 days from now, 3 hours from now, or 3 weeks from now, that is a short term, if you make money, capital gain, and that is going to be taxed as income, not as a capital gain. So you end up giving up a bigger percentage of your gain to the tax man. And so just be careful if you're a young, successful, person out there working, you got a good job, but you're single, and let's just say you're making $100,000 a year. You may not realize it, but you're basically in the 30% marginal tax bracket for every dollar you make going forward. Fed, you'd be at about 24% today, and then another 6.84 here to the state of Nebraska. So you're paying basically 31%. So if you make a couple $1,000s on a short-term trade, remember, you're giving up 31% of that to the government. You need to account for that and plan for that before you get to the end of the year and all of a sudden owe a bunch of money to taxes and you're not prepared for it, because we do see that happen sometimes.
Absolutely.
So with the robo-advisors, these guys were born out of the Great Recession. Technology started to come to the forefront, and the big ones like Wealthfront and Betterment are these two gigantic ones. And the idea is they're trying to cut out expenses, right? So if you don't want tax advice or an actual income plan, if you just want to asset allocate, they were a cheaper option. But again, most people migrating to these type of apps or these robo-advisors were either very short-term in nature. I just full guiltiness. Both of my adult kids have been on apps like this, and long term from them was they went through lunch with the trade, right? And so we want people to understand there's a difference between trading and investing, number one, and two, understand the tax implications of those. But you brought up a really good point, Alex. Is the with AI, a lot of these robo-advisors are getting advanced, and there's some slick websites, and we call this fintech. And so what they're doing is trying to dial in what's your real time horizon. So some of them are legit for long-term investing and long-term planning. And so, hey, I'm 25, I'm starting to make $55,000 a year, and I want to put away 20% of my income, et cetera, whatever it is. And they will kind of build you a path, obviously born out of assumptions, assumed rate of return, et cetera, and show you how to start putting money away. But what they don't do is that, like the tax planning typically, et cetera. So I think you're right. There are better versions of these, and technology is so advancing so fast. They are better than a lot of what's called the target date funds. And unfortunately for most Gen Zs like you or the millennials, you guys go sign up at work, and the 401k doesn't have a lot of choices. We have the 2030 fund. We have the 2035 fund. Oh, we have the 2040 fund. We're going to diversify you, right? And all the funds hold the exact same holdings, and they just change the weightings based on that target end date. And the idea behind that is the younger you are, the more stocks you should have and less bonds, and vice versa, and the older you get. But that's not really true diversification, though, is it?
No, and I think part of where a real human advisor makes their money is really in the other value adds outside of investing, bringing in tax advice, teaching younger clients how important cash flow can be in their financial situation. So a lot of things that maybe the robo-advisor wouldn't consider as important can be a lot bigger factors than people realize.
Absolutely. So like we have our proprietary smart planning process, and it works for somebody of all ages. We focus primarily here on retirees, but younger clients, and we do have them come in. We have kids of our clients come in and ask for our help, and we're gonna talk about your income plan today, how much money you're making. We're gonna assume you're making raises each year, so your income should be growing over your career. But we want to make sure you're helping manage your expenses. If you unfortunately have debt, if you come out of school and you got student loan debt, obviously very common today, or car loans, what have you, we want to show you how to structure a way to get out of debt as fast as possible, but not at the detriment of not investing, right? And that's where Dave Ramsey and I differ. And and just full disclosure, I've taught his class called Financial Peace at my church, but I do not want you to just put off investing to someday, because you lose out on compounding. If I can get you investing at a young age, man, basically your money, if the rule of 72, you want to explain the rule of 72? So
yeah, the rule of 72 is just any interest rate that you divide by 72. That's how often your money will double. So if you want your money to double in 10 years, you got to get a 7.2% rate of return.
And historically speaking, the S&P has given us just around 9%. So every 8 years, if you were in a full stock portfolio, you would double your money, right? Now, there's some risk involved there. We're not saying that's what you should do, However, if you're 18 and open your first Roth IRA at your first part-time job, I don't care if you're working at Casey's or Taco Bell, you just get $5,000 in that tax-free account and then double that every 8 years at 18. You do the math, man, you'll have over $500,000 available to you in retirement tax free, and that's key, never to be taxed again. So understanding the taxation, as you just brought up, is critical. Also, we want to talk about how the A in the SMART plan is the advanced planning, legacy planning. You're never too young to start with like an estate plan. We just had we had over 150 people attend this week, our estate planning classes, which was mind-boggling how popular these classes are getting. But you're never too young to get up an estate plan. Once you have assets, you should start to think about, hey, if God forbid, if something happens, and it will happen to some people young, unfortunately, who do you want to be the beneficiary, right? And we see this all the time. Parents that unfortunately have gone through the pain that my wife's parents went through of losing a child in their 30s or something young, that kid has assets somewhere and they have to be dispersed, and there's no beneficiary. They have to go through probate and all kinds of problems because, I'm 25. I don't need to worry about a beneficiary. I'm not married. You should be thinking about this stuff all the way through, right?
Yeah, and life happens too. I mean, we've had a couple clients come in where their parents pass away unexpectedly, and then they're thrust into a much larger financial sum than they're ever used to, and so being prepared for that can be important.
Well, this brings up another article that you had sent me. Forbes had this article, and basically it talks about the greatest wealth transfer in history, what is happening and what's going to happen, and what are these implications. And so baby boomers, obviously, most people know what a baby boomer is, but basically that's people born from World War II all the way through 1965, right? They've been retiring at a record pace of over 10,000 people a day for about a decade now. And next year, that ramps up to over 12,000 a day. We get to the peak of that, and we've got about another 7-year run as that's going to continue. But as they are getting into their 80s, the first baby boomers are now, 82 years of age, 83 years of age. They are, as they pass away, going to be passing down wealth. Now, one, there's some tax problems there.
Mm-hmm.
We know our government needs some money, right? And two, who's going to benefit and inherit those dollars? And just talk about why it's so important to have a good fiduciary-based independent advisor planning for those transitions from what you've learned already.
Yeah, it's important to have a fiduciary-based advisor. So, in a lot of these cases, your generation unfortunately gets skipped in this whole thing.
Yeah, we are the sandwich generation. What he's talking about is I'm Gen X, so I'm 55, right? And so the baby boomers are ahead of us, the Gen Xers, and then the millennials behind us, and a lot of the wealth is going to go from the boomers to the millennials, and it's going to skip the Gen Xers, even though a lot of Gen Xers like myself are what we call sandwich generation. We may be helping our parents out financially and then helping our adult kids out still.
Yeah, so it's important to have that fiduciary-based advisor that can understand, if the Gen X generation is doing well, then maybe it is a strategy that we need to implement to maybe skip a generation to pass those assets down tax efficient.
And that can be a huge tax benefit for the family lineage, right? If it's not needed by the next generation. So again, great points all the way around of why it is so important. No matter what age you are, you need to be planning. And we always say, never hire a financial advisor older than you, which is why we have such a crop of young talent in here, because we have clients coming on board now of all ages, and we need to them have advisors that are younger than them, because you never want your advisor to retire before you do. So holy cow, man, this time's already gone by here for this segment, Alex. So I think this is some pretty good content, and we're going to put you on the spot and let everybody know that you're going to be helping lead a Start Smart class here. We're not probably going to get it launched until the first of the year, but it is focused on those young professionals that are just starting to really earn some money. They're in their first or second job in their career, starting to put some money away, and they need help so they don't just go to the wrong app or fintech and not get any sound and round advice. So thank you so much for taking time to stop by this week.
Thanks for having me on.
All right, guys. So, Chip, what is next?
Up next, you have questions. David Brooks has answers. Q&A is next on Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Into the Q&A we go. David, the first question is about economic indicators. And the question is, I don't get it. The stock market goes up, but at the same time, the CPI and PPI are going up. Isn't that contradictory? Shouldn't market indicators and inflation indicators move in opposite directions? David.
Well, sometimes yes, and sometimes no. So it's a valid question though. And so the reason you see an initial move positively, on these numbers is the CPI did not go up greater than expected, and so the reason the positive is they think, okay, the Fed's done. So the market's short-term reaction is the Fed's going to be done hiking rates, right? And so if they believe the Fed's done hiking rates, then they think, okay, no more interest rate hikes is going to be harmful long term. However, we're just now seeing what the output is of the hikes that started a year and a half ago, right? So it takes some time, 9 to 14 months, to see it come to fruition, what damage they do to the economy. And that's why there's a lot of people now asking the Fed to pause, and they agreed to pause all the way through September, get 2 more months of data before they decide to do anything again. But if inflation keeps going, they could come back and raise rates again. But again, we have to be cautionary and point out that once the Fed pauses, historically speaking, it's not the greatest news for the stock market. So in the short run, well, there's no more rate, so it may rally a couple percentage points off of that. Historically speaking, once they've paused in each of the cycles, the average drawdown in the last 7 is greater than 20%. That's average, Chip. So we've seen 7% drawdowns, we've seen 50% drawdowns. So who knows where we go for sure? But typically the other problem is people are like, oh, the Fed's going to start lowering rates next year. In fact, I think it was Goldman Sachs put out a piece this week. Inflation will get down to the two handle next year, and the Fed will start to reduce rates. Well, why would they reduce rates? So if inflation hits the goal, do they have to reduce rates to hit their inflation target?
No.
No, it's already there. When they start reducing rates, it's because the economy is in trouble and they're going to try to pick it up. And so therefore, the first set of hikes usually means continued down draws on stock markets and things like that. So again, this is why you want to work with somebody who's going to help you understand how much risk and volatility you're comfortable taking within your portfolio. And then we can just show you historical data of what happens and design a portfolio to at least where you're comfortable. But there's always going to be some form of risk out there.
You're still seeing more storm clouds than sunshine on the horizon when it comes to the economy.
I'm predicting a hard landing still at this point.
Okay.
Because that's what the data points to. I mean
some other voices are going the other way.
Yeah, they are.
Not.
No. And like I said, we usually get this stuff right, but I am guilty sometimes of being early on the calls, but the data is pointing out. I mean, we see Europe in recession. And by the way, we didn't get to it. We might get to it in the fourth segment. We had an article we were going to try and talk about in the first segment today's show, and we didn't have time, but you're seeing China implode. The real estate market in China is literally imploding before our eyes. In fact, Joe Biden called it out. I thought that was interesting. We agreed on something. So, I would tell you we do not see a rosy forecast going forward.
We will have to circle back to that China story if we've got you and the president agreeing on something. In the meantime, David, the next question is about taxes. You often talk about the Trump tax cuts sunsetting in 2026. I read an article about possible congressional action to preserve and maybe improve tax benefits for 2026 and beyond. Republicans want to raise the standard deduction. Democrats want to raise child tax credits. Do you think any of this has a chance of becoming law?
Well, it certainly has a chance of becoming law. But number one, the Democrats just took away child tax credits this year. $1,000 per child was pulled back from Biden's infrastructure bill. So that was Democrats voting to take that very benefit away. And the Republicans, yes, when Trump's tax bill expires here in 2.5 years, standard deduction gets cut in half, basically, from what it is today. So there is several versions of legislation in committees, both bipartisan, to maybe keep it where it is. Now, here's the reality. Depending upon who's in control of Congress at that time, so obviously the election's next November, nothing's changed between now and then, okay? There's not going to be any changes. But once we get past that election, depending on what Congress's congressional makeup is, Republicans and Democrats, et cetera, and who's the president going into 25, you'll see some movement there. And the problem is, again, we're so partisan now. If one person wants it now, they may change their mind if the other party wants it just because of positioning. And that's the reality. So again, who cares about the party or person? We care about the policy and what it does for you, and we'll explain that to you either way. But yes, there is provisions to keep these tax cuts permanent. And in fact, there's even provisions by some to make it even more aggressive and we may need that to grow our way out of the economy, because you can't tax your way out of it, just like you can't borrow your way out of it. And unfortunately, that seems to be also the call for several members of Congress, is they just want to flat out raise taxes on everybody, and that would crush the economic output of our country. But again, that's what happened before, and it took a couple of decades to get through it. So we'll see where we go. It's a great question, and no one has the perfect crystal ball politically.
I suppose the dust is going to have to settle after the 2024 election cycle, and then we might be able to answer that question.
Well, I thought it was interesting.
Concretely.
I was listening to some talk radio this week, some national guys, and they were just talking about the different VP picks that people would make based on the congressional makeup, right? Because now, let's face it, the reality, we're so partisan. Whoever ends up being the nominee for each party, all right, and Trump or whoever, right, for the Republicans, and if it's obviously ultimately Biden or Robert Kennedy Jr. or somebody else, who they check off or pick as their VP candidate is, can they deliver a state, period, right? Because the Electoral College, everybody's is doing the math on all that stuff. So again, we'll see what the makeup looks like, but this is why the local votes are so important, though, and we cannot stress enough, you need to be voting in your school boards and your city councils, even if you don't have kids in school, because they are spending your money, and there's nothing wrong with that, but you should certainly make them, be responsible, be fiduciaries of your tax dollars.
David, here's a question about Social Security. I'm 70 and just started receiving Social Security benefits. If I start withdrawing from my IRA, or when I hit the age of required minimum distributions and have to start withdrawing from my IRA, will that reduce my Social Security payment?
It will not. So once you're past full retirement age, you don't have to worry about the reductions. When you draw early, you do. But at 70, you can have unlimited income, and your Social Security will not be reduced in any way, shape, or form. However, depending on what other taxable income you have, it could or will make more of your Social Security taxable. So remember, your Social Security income, you do not have to pay taxes on it if you don't have any other taxable income. But if you do have taxable income greater than your Social Security income, depending on how big your Social Security income is and how big your income is, up to 85% of your Social Security now becomes taxable at your marginal tax rate.
Well, we say in our Social Security workshop, there are a variety of options for how and when to take Social Security. It's very important that you know them and exercise them in the right way at the right time to optimize your benefits. David, that's all the time we have this week for Q&A, but how many openings do we have for a 15-minute phone conference with one of our advisors?
So we have 8 of those available. I'm not going to be able to do any myself because I got to go to New York.
He'll be ringing a bell at the New York Stock Exchange, but we have other advisors on the team. You hear them from week to week now on our show, and what you can do is, at no charge and no obligation, call us at 402-369-7777 and schedule a 15-minute phone conference with one of our advisors. Do you have a question about retirement? It's a nice way to dip a toe in the water and get the conversation started. Give us a call at 402-369-7777, but don't wait. Those appointments fill up. We have 8 of them for this week. 402-369-7777. Up next, what do Ronald Reagan, Nelson Mandela, Sylvester Stallone, and David Brooks have in common? Ponder that one during the break, and we'll give you the answer on the other side. You're listening to Retire Smart with David Brooks. Welcome back to Retire Smart with David Brooks. I'm Chip Maxwell. Well, let me hit you with that again, friends. We went to the break. I said, what do Ronald Reagan, Nelson Mandela, Sylvester Stallone, and David Brooks have in common? David, I think I even stumped you with this one.
You did, because I'm going through that list, and Sylvester Stallone and I actually share the same birthday, and I just know that because when they talk about your celebrities,
well, that's
close. And a different president, actually, George W. Bush, shares the same birthday as well. So I'm like, wait a minute, what is he talking about, Ronald Reagan? So go ahead. You let me know during the break. I did not know this.
I am milking the New York Stock Exchange for all it's worth. In case you missed the early part of the show, the opening, David Brooks is going to ring the opening bell at the New York Stock Exchange. So all of the people I mentioned there either have or are about to ring the opening bell at the New York Stock Exchange. I wasn't kidding when I said you're going to step into history here.
Well, and it's true, and it's actually Ronald Reagan was the one that kind of made it become a prestigious thing to do. They just rang the bell every day prior to that, but he came on board and did it, I think, in 1985 after reading your article there, and kind of turned it into, and it's kind of a unique thing, and obviously there's only about 180 shots a year to do it, so it is kind of a cool thing. So
fantastic. I can't wait to hear about it on the other side as well. All right, now, David, we got to get back to that story that you referenced before. It's not often that you and President Biden agree on something, but here is the headline from Fox Business. Biden says China is ticking time bomb due to economic woes. You also have mentioned a few times in recent months that China's starting to wobble somewhat economically.
Quite a bit, actually. So, and not only this story, but over the last weekend, there was a couple of news reports. In fact, Monday, the overnight trading before we started our week, the Hang Seng in Hong Kong was down over 2.5%, and that is basically on China. Real estate developer companies were getting crushed, down 15+%. You're having people vacate, and so I even had to explain this to our advisors. And again, so every country is a little different, right? Like here, you go build a house, you don't get your final mortgage till you CO the house and start. In China, that's not how it operates. You start paying your mortgage, Chip, when you sign the dotted line for them to construct your condo, and they build tons of high rises in cities and things over there. There's over 3 dozen cities larger than New York City. It's huge, and so when they overbuild, people they've been paying these payments, and the economy slows down. They can't pay the payments, so they stop. And you've had millions of them stop paying, and these developers are caught holding the bag on all this interest. It's all financed on debt. Even in China. And so people are like, oh, China's going to own the U.S. I don't think so. And there's plenty of reasons why the dollar's actually gotten stronger 6 of the last 8 weeks, not weaker. Again, we keep seeing all these gold IRA commercials, et cetera. But China is in trouble, and they reported anemic growth. And so their economy for the last quarter only grew at like 0.2%. And we always used to joke about the GDP numbers out of China, that the old Wall Street math was to whatever they report, cut it in half, right? Because they're not going to quite give you the straight story. And so if they're saying they grew at a small percent, a couple of 2.4% or whatever, they probably didn't grow at all. And for China, with that population, not to grow at 5%, for them growing at 5% is like us growing at about 2.5%. All right, because of just the simply what they need for over 1 billion people for that economy to flourish and grow. And so they're going into a tailspin the wrong direction, and that does not bode well for exporting goods and services to the rest of the world, which is again what we talked about last week, Chip. Trucking data falling off a cliff, right? The trucks are not delivering goods and services in the ports,
yellow trucking shutting down, right? Yeah.
And then on top of that, to complicate it, we just talked about, I think the Panama Canal had like 150 ships blocked in it. It had drought problems, and so shipping of what goods and services are moving is delayed.
Goodness.
All this data is going to come out in the coming months, and we just had retail sales; they weren't robust, et cetera. So anyway, it is and Biden's talking about they're a ticking time bomb, so yeah, they could be, So again, we agree on something finally.
Well, this reminds me, I was in a recent conversation with a client of ours at Retire Smart who does business in China. And he was talking about a recent negotiation. Well, he was laughing, saying, it used to be you didn't really get to negotiate with China. China just told you what you could do or not do if you want to do business in our country. But he said, actually, now it's a little bit more of a negotiation. There's, willingness to concede on both sides. There's a little more leverage for the American in the conversation because China needs us to engage in its economy.
Well, yeah, if they can't export the products that they make much cheaper than America makes, then there's no one for them to buy it, which means their economy goes. And we're seeing that push, too. People are getting prideful about what they buy. So you're seeing people buy American-made again. We're seeing a big influx in that. And so people are starting the patriotism that people want to support American jobs, especially in certain types of manufacturing. You're starting to see chips get made here, semiconductors, et cetera. So if that, which has been a huge piece of the economic pie for the Far East, comes to our shores, that would be good for us and not so good for them.
Well, speaking of our shores here, back here at home, David, you sent me this story, and this just sent a chill down my spine. I couldn't believe it. But the CNBC headline is, retailers say organized theft is biting into profits, but internal issues may really be to blame. Employees ripping off the employers, David?
Well, so what it is you've got organized theft, which is, and if you've seen any of the videos out there, like in California, they're just pretty brazen. That no mask, nothing, just walk in the store, and if you don't steal, I think it's $950 under some of the rules out there. They don't prosecute you, so they walk in and they know exactly what to grab and walk out. I mean, you see people going in and grabbing handfuls of clothing and Nike suits or shoes or what have you, and then people. Well, we've talked about it. People have gotten fired that have stopped them. The employee gets the reprimand, but not the people. It's just it doesn't make any logical sense. But these numbers have gotten so bad that now companies, because retail sales we just talked about aren't so strong, they're using this to blame it. Oh, this is why, when it may not be the case. When you do the internal data, no, their inventory, their purchasing was wrong, and that's why they're getting stuck with so much inventory. And so we've seen this with companies like Under Armour, Nike, Columbia Sportswear, North Face, all these companies. The supply chains were so messed up 2 years ago. Everybody over-ordered just to get stuff in stock, and now people aren't buying as much, and they have extra inventory, and they're having to write it off, right? And so theft is happening because they have extra stuff in their warehouses. People might be taking stuff home for sure, but it's really just mismanagement of the supply chain, and that is creating economic pain.
All right. Well, I guess that's somewhat good news that it isn't just a whole insider racketeering operation going on. David, I can't get past the conventional notion that the bond is the safe haven of the financial world. But you have been sounding the alarm for the better part of a year, and now the Financial Times of London is chiming in as well. The headline is simply, bonds are no longer the safe option.
Well, we talked about it for the last 3 years. Bonds were going to get ugly, and they've had a negative return for 36 months. However, I will tell you the timing of this article, and one came out one day later in the Wall Street Journal, basically referencing the same people and the same story. And then one of my favorite economists to follow, Mohammed El-Elron, who
we quote him often on this show.
He kind of called BS, if you will, on some of these articles. And interesting, the people that they quote on this are known to be shorting the bond market right now. So it's like let me give an editorial story to press it down. So while bonds have been horrible as of late, tactically, we think you're going to be into a window where owning bonds for the next couple of quarters could be one of the best things you could do, because if the Fed is at the end of the hiking cycle, as most of Wall Street's telling you are, the bond yields will start to fade, Chip, and if yields go down, prices go up. It's an inverse relationship. So the reason bonds have gone down so bad last 36 months is because rates or yields have gone up. So if that is going to reverse itself, like several of those same talking heads are talking about, then this is nonsense. So I call suspect on the timing of it. I absolutely told our clients that bonds 3-4 years ago were going to be in trouble in the near, and it's happened. However, tactically speaking, we think it may be a place to allocate some dollars here in the near term, but again, not long term, because you're correct. People don't quite have the same faith in our bond market as they once did.
This is why you need to check in with a financial professional. Well, first of all, a great first step is the tax guide that we offer. No charge, no obligation. That is 32 pages, chock full of charts, graphs, and strategies. Now, if you do want to dip a toe in the water, we have 8 openings this week for a 15-minute phone conference with one of our licensed advisors. You have a question about your retirement? Give us a call, 402-369-7777. Same number for the tax guide, 402-369-7777. And we can set up one of those 15-minute calls for you. If you want to take the plunge and get the report card, that's also 402-369-7777. That's the comprehensive review of your entire situation and recommendations on what you might want to do going forward. 402-369-7777. David Walker's coming to town in September. Now, it's at an arena, but the seating is limited. So give us a call. Say it with me, friends. 402-369-7777. If you would like to join us to hear the former U.S. Comptroller General sound the alarm on the fiscal crisis, but also lay out a plan for regaining fiscal sanity in America, getting back on solid ground fiscally. That's David Walker, Thursday, September 14th at 7 p.m. at the Liberty First Credit Union Arena in Ralston, near 72nd and Q. Join us, but register 402-369-7777. David, bring us home.
Hey, have a blessed and prosperous week, and we'll talk to you next time.
Thank you for listening to Retire Smart with David Brooks. I'm Chip Maxwell. For David Brooks and the entire team at Retire Smart, have a great week. Companies on the 2023 Inc. 5000 list are ranked according to percentage of revenue growth from 2019 to 2022. The full 2023 Inc. 5000 list was published in August 2023. Smart Wealth, let's keep going. Smart Wealth paid Inc. magazine a non-refundable processing fee to be considered for inclusion on the Inc. 5000 list.